Hello and welcome to Session 8 of our Series 7 exam overviews, once again brought to you by Passing Score. In this video, we'll be going over broker-dealer rules. This includes compliance, legal requirements, and dealings with customers. First, why are they called broker-dealers? Well, they act in two roles. First, as a principal or dealer, and this is when they're trading on their own behalf, taking their own risk with their own funds. Secondly, they can work as an agent or broker, transacting on behalf of a client for a commission. This can include not only just trading, but research, advice, and other complementary investment services. Here's a quick breakdown. Dealers or principals act on their own behalf, sell to clients at a markup from their own inventory. Brokers or agents are transacting on behalf of a client for a commission, and this can involve other services as well. Broker-dealers are required to have SIPC insurance, which is insurance protection for clients if the broker-dealer fails. They're only required if they have interstate commerce, which is almost all broker-dealers, but if the broker-dealer has purely all their business within one state, they are not required to be members of SIPC. And once again, as we saw in a prior video, the coverage is $500,000 for total securities and cash, of which $250,000 maximum can be cash. $500,000, $250,000, and SIPC is the broker-dealer insurance. Broker-dealers are also subject to the same reporting requirements as other financial institutions, and this includes things like the CTR, which is a report of any cash transactions that total $10,000 in one day, so the aggregate transactions. If a client withdraws $3,000 in cash at one branch in the morning and then goes to another branch and withdraws another $8,000, that will trigger the filing of a CTR. The CMIR is $10,000 that's moving into or out of the United States. In that case, the CMIR must be filed. An SAR is for transactions of $5,000 or greater that are suspected might be related to some illegal activity. And what triggers this report is a little bit subjective. It depends on the institution and maybe sometimes the employee as to what they might consider a suspicious activity. AML is a very important compliance for broker-dealers. They must have an anti-money laundering program. If not, they can be subject to 20 years in jail and substantial fees. For that reason, the compliance group is usually very focused on maintaining good compliance with AML. That compliance must be in writing, approved by senior management, and include certain policies, including designating an officer responsible for the program and training of their employees, as well as audits to make sure the program is working well. Again, $500,000 in fines or 2 times the money involved for failure to comply with anti-money laundering rules. Broker-dealers must also make sure that they're identifying their clients properly. They must check them against a list called OFAC. This is a list of known and suspected criminals. For U.S. citizens, it's a short list of information they must obtain, plus one of the following IDs for non-citizens. Institutional investors have different rules than retail investors because they're much larger and have a high risk tolerance relative to a retail investor. These involve financial institutions, government entities, and even individuals if they have greater than $50 million in assets. Accounts can be shared between a registered rep and a client as long as it's a joint account and the registered rep has made a financial contribution to the account and the profits and losses are shared proportionally according to the financial contributions. This is to avoid any issues where there's some kind of compensation given to the registered rep from the clients for services outside of the broker-dealer that might not be allowed. Client information must be obtained by the broker-dealer, including this list. Principally the name, address, legal age, but all of these are required. There is another list of information that the broker-dealer has to make their best efforts, but are not strictly required to obtain. if the client happens to be an employee of another broker-dealer, they must give written notice to the employer's broker-dealer that they're going to open an account, and they have to comply with any requests from that employer, including providing copies of confirmation and any written instructions that the employer firm requests. Margin accounts require their own separate forms. That includes the credit agreement, hypothecation agreement, loan consent agreement, and you can remember that simply by CHC, credit hypothecation consent, for a margin account. Hypothecation is actually when the broker-dealer is borrowing money using the customer securities. They can borrow up to 140% of the net balance of the client account. And in this example, the client has bought $10,000 of security, but has only deposited $10,000 of cash. Their loan margin balance is $10,000. So the broker-dealer can borrow 140% of that, or $14,000. Options accounts are considered more risky and are for more sophisticated investors. So broker-dealers have to obtain the financial knowledge and experience of the client before opening an account, and must provide several disclosures and get approvals before opening the account. This includes approval by the registered options principal, and the client has 15 days from approval to sign and return their disclosures. This is to avoid customers who can get into big trouble if they don't have a good handle on how to use their options accounts. Finally, broker-dealers have to obtain what the client's objectives are when they're making their investments. Are they looking for current income? Are they looking for growth? Are they a low-risk type of client who is just looking to avoid any losses? Or do they have certain tax requirements and tax benefits that they seek to obtain? The broker-dealer should get a good sense of what kind of account the client is opening. Well, that's it for our broker-dealer section. If you have any questions, please feel free to email me at john@passingscorefinance.com, and good luck on your exam.